Hi, I'm Dominic Picardo here for the May issue of Spreadbet magazine, and today I'm asking whether the bubble has finally burst in the price of gold, and if so, what trading opportunities might there be one way or the other. So, first of all, let's take a look at this amazing plunge that we've seen in the price of the yellow metal just lately. At the start of April, gold was trading around $1,600 an ounce. And then, in just 11 catastrophic trading sessions, the price plunged to an intraday low of $1,322 an ounce. Now, this would have hurt a lot of people, particularly spread bettors like you and me, because we can see from the spread betting industry's positioning data, a lot of retail traders were heavily long of gold at the time that the crash kicked in, and also they were specific. They have been for much of this year as it goes. Now, as a result of this huge sell-off that we've seen, gold has now returned to the sort of levels that it was in late 2010, early 2011, just before gold really took off into this impressive spike upwards. And that's at this point here, gold had reached an all-time high of around $1,929 per ounce. Now, quite a few cynics at the time said that this sort of move represented a bubble, that gold had gone far too far, and it was all driven, according to them, by irrational fear over the economic outlook, and particularly there was the U.S. Budgetary crisis at the time, which was eventually resolved. So, are the gold cynics right? Was this a bubble? Was the giant move from the late 2000s? Did it take gold to irrational extremes? Now, the first thing to note is that, well, we have had a kind of bubble in gold before. Back in the 1970s, gold, at least in its latter stages, entered what was to many people was a bubble. The price took off in 1979 almost vertically, shooting up, and this to many people would qualify as a bubble. And of course, but gold then crashed and then took another couple of decades before it ever got back or returned to a bull market. So it's, first of all, I don't think you can really compare that sort of move up in 2011 to this absolutely enormous spike. So we can see that in 1979 the gold price went from to around at the end of 1978 it was around $200 an ounce, and then by the beginning of 1980 it had hit $850, and that's a much bigger move than anything we've seen so far. And also the subsequent sell-off was much bigger than what we've had so far. In just 2 months, the price of gold sold off 43%. And what I would say is that until very recently, gold, having risen in a much more steady and sustainable fashion, has actually been correcting in quite a modest style. At the lowest points here, gold was only off around 20% from its highs, and that's really no gate shakes in the scheme of things. So I would have called this a pretty standard, a pretty modest correction actually within a long-term bull market. So can I actually maintain that now? Because I'm a gold bull. I've argued that gold was going to go very much higher. For me, I see the long-term uptrend as not having been essentially violated quite yet. I believe that if we compare this sell-off here to some of those in the past, you can see why. In the course of this bull market, even we've had at least one correction, which was, if anything, bigger than today's. In 2008, during the worst of the financial turmoil surrounding Lehman Brothers and so forth, gold was down by some 38% or so. So that's a bigger move than we've seen already today. And a lot of people there would have said it's all over for gold. We're going into a deflationary crisis. and no one's going to have any use for this. And of course, then we got this terrific move up from $700 or so an ounce up to those all-time highs. Gold more than doubled after that. So, but really, the precedent I wanted to look at was the 1970s, because the 1970s saw a two-stage bull market in gold. First of all, we went up from around $30 an ounce down here up to a high here of just under $200 an ounce. Then the price of gold shed half its value, and by the time it had fallen here in 1976, and this was a good time for the stock market at this point. The stock market had been doing badly here as gold was going up. Then it started to do well here. Like today, investors were shifting into the stock market in search of better returns. And you would have had to say down here, most people would have thought that gold bull market is over. You don't get something which falls 50%. Most people would have thought it was over. In fact, the best was yet to come. Gold got near oversold on its monthly chart, an RSI reading of around 31% on the monthly chart. It's a very low reading, very oversold. And then there began this explosive move up where gold went from around $100 an ounce to $850. So that was the best of the bull market. And I would say that today we are probably only somewhere midway through the bull market in gold. I think gold still has a long way to go up on the upside. I think that's a result of the wanton inflationary policies that the central banks are pursuing, and they're going to pursue for a long time yet in order to try and inflate away the debt. And I believe we'll only see a final top in gold like this one here once they get serious about inflation, or about choking off inflation rather than creating inflation. And for now, we are nowhere near that point. So what do we want to do for now? What's the strategy here and now when it comes to the price of gold? Well, first of all, I wouldn't necessarily call a bottom in the price of gold. This has been a very choppy ascent off the lows. It could indeed mark a bottom, but I really need to see more evidence. And until my bias would be bearish, I think I can see the dollar strengthening some more especially given the situation in the eurozone. And my bias, especially if gold is below this 21-day exponential moving average, I think a good strategy when it would be to be entering short positions when the price gets to that, and then the price drops back through it, and that's paid off pretty nicely in the last few months or so. So ultimately, though, I do see another great buying opportunity coming. And particularly if gold became as oversold as it did back in the early 1970s and then had a strong bounce, that from a longer term gold buying opportunity I would be very keen to take. In the near term, though, I think we can also look back to when the moment to buy in there, when we knew the downtrend was over. Now the line you can see here, well, it's a sort of 10-month moving average, roughly a 200-day moving average, and I think the time to buy after that correction was when the price of gold broke back above that 200-day moving average. So that would be the sort of signal that I'd be looking for again to a big breach of that in order to confirm that the massive gains in gold that I'm forecasting for the future were likely underway.